Hello, everyone, and welcome to this webinar on market risk and counterparty credit risk. So, those who don't know me, a little bit introduction about myself. My name is Satya, and I am the one of the partners in Peaks to Tails. I lead the quantitative finance and market risk counterparty credit risk side of the things. Um, I'm very passionate about quant in general, and that's where I specialize. I also lead the machine learning course in Peaks to Tails. So today's webinar is about this particular course that I lead, which is Market Risk and Counterparty Credit Risk on Peaks to Tails. So we'll talk a little bit about what this particular topic is all about. So I'll give you a high level overview of all the important concepts and components and everything, how everything is linked together, so that you have a big, macro picture of market risk as well as counterparty credit risk. And we'll focus on some of the key concepts that you need to master to be able to excel in this particular space. Okay, so I'll highlight everything in the big picture walkthrough, and yeah, and then we'll talk about some job opportunities and any other questions that you might have. I'll also spend some time explaining how I teach, what are the different types of materials that we provide to help in your learning process. So yeah, that's pretty much what the agenda is. So let's get started with market risk. I only have two slides, by the way. So before I, thought of conducting this webinar, I asked this question to myself: Can I summarize the whole market risk in one slide? Just one slide. So that's what I've tried to done. But it's little bit at a high level. Obviously, we cannot see all the moving parts, but this should give you a connected understanding of all the various moving parts in market risk. So let's get started, and feel free to pause. I mean, stop me and ask any questions that you might have. All right. Okay. So in market risk, we have at a very high level, right? We have broad asset classes. Broad asset classes. Okay. I think the name is self-explanatory. Within the, let me get the pointer here. One moment. Yeah. So within the broad asset classes, these are some of the asset classes that we have: interest rate, FX, equity, commodity. You can have more granular asset classes as well, but let's keep it at this level. Okay. And then we have risk factors. Okay. So we have risk factors. For now, I'm assuming just two risk factors, X and Y. Okay. At the moment, so this is the current scenario. Right now or today, there are values of the risk factors that you can see in the market. Okay. So these are the current values of the risk factors. Now, these risk factors belong to these asset classes. They fall under some asset class. Okay. So, for example, if you're talking about interest rate as an asset class, what kind of risk factors would fall under interest rate? Can you name just a couple, maybe? Just tell me names of risk factors that fall under interest rate. Risk factors. Okay. Okay. Lakshya says bond. See, bond is an instrument, it is not a risk factor. Please, everybody respond. Do not hesitate. This is a very safe space. Okay. Nobody is judging you. Inflation, yields. Yes. So those are the risk factors. Correct. Spot rate curve, forward rate curve, inflation. Um, then we have yields. Okay. All of these are interest rate risk factors. Similarly, if we go to equity, can you name two types of risk factors in equity? Risk factors in equity. Equity price, yes, or you can say equity spot price. There is one more which is specific to options. Equity volatility, yes, exactly. That's correct. So for volatility, again, it gets complicated. We have volatility smile, we have volatility surface, and all these things. We also have them under IR as well. So for interest rate options like caps, floors, swaptions, we need the volatility as a risk factor as well. Okay. All right. So you have some understanding of risk factors and under which asset class they fall. So once we know these risk factors, right, the values of the risk factors today, right, so it could be like, let's say, think of interest rate. So 1 year rate, 5 year rate, 10 year rate today. Okay, so those are the risk factors today. And then we have instruments. So instruments are nothing but set of cash flows. Is just a package of cash flows, future cash flows. That's what an instrument is, right? Those cash flows can be deterministic or stochastic, right? Deterministic means you know for sure that's the cash flow that you're gonna get, discounting possibilities of default and other things, right? If somebody defaults, then you don't get the cash flow. I'm just ignoring default for now. Default is really the domain of credit risk, but sometimes there is default events that we have to capture under market risk as well. Okay, so for example, if you have instruments that you are trading on your trading book, then the issuer can default, and that is not captured anywhere else, so you have to capture it under the market risk. Okay, then again, that's a nuanced topic. Let's not go there. Cash flows can be deterministic or stochastic. Deterministic means you know with a certain level of certainty that this is my cash flow. Simple example, fixed rate coupon bond. I know what the coupon rate is. I know what all the coupon payments would be, right? Uh, for floating rate, you need to do a projection. Okay, you have to project the using the cash flow projection. For taking a forward curve, you have to project the cash flows. Stochastic is specifically for options where you don't know what the payoff would be until you reach expiry. You don't know. Okay, but there are different possible payoffs, but at expiry you don't know. Example, call option. You don't know what the exact payoff would be. So that's random or stochastic. Okay, so we have instruments that are packages of cash flows. Cash flows can be deterministic or stochastic. Now, what we do at this moment is, okay, before that, one more thing. I have tried to highlight the topics in red which are part of hardcore financial engineering or quant finance. So remember, I told you, right? I specialized in the quant side of the thing. So I teach two courses, actually three courses. One is quant finance, one is market risk and counterparty credit risk, and then machine learning. So right now we are focusing on market risk, but I'll highlight some of the topics which you see in red. Those are relevant for quant finance, like hardcore quant finance or financial engineering. The concepts that you'll see in orange, which are coming, okay, are relevant for market risk. So that's the color coding. Keep it in mind, okay? So normally we assume some kind of stochastic process for the risk factors. So you must have heard stock prices diffuse log normally, or they follow geometric Brownian motion process, right? That's one of the assumptions. So that's a stochastic process. Once you define the stochastic process for the risk factors, you can develop a pricing equation for the instrument. When you have instruments, instruments have values. To derive the value, you need a pricing equation. Okay? And from the pricing equation, you can solve the value. So let's see. How do you go from here to here? There is a branch of mathematics called as stochastic calculus. And this is the bread and butter of quant finance. The concepts that you see in green are the fundamental, core concepts that you need to master for a particular domain. So if you want to be a champion of quant finance, you have to master stochastic calculus. Okay, this is the bread and butter for quant finance. So assume some stochastic process for the risk factors. Using stochastic calculus and a lot of manipulation here and there, you arrive at the pricing equation. Pricing equation can be in form of a partial differential equation, something like this. Can you tell me what equation this is? There is a name for this equation. It's the most famous equation in all of finance or quant finance, should I say. Black-Scholes partial differential equation. Excellent. So pricing equation can be in form of a partial differential equation. Example is Black-Scholes, PDE. Or it can be in form of an expectation or conditional expectation. Okay. So value of an instrument is the expected discounted payoff. Don't worry about these notations. These are all part of quant finance. I'm just giving you a high level overview, right? So pricing equation can be in form of a PDE or it can be in form of an expectation. Okay. How do you solve this? There are two methods. If you have the differential equation, you can solve it analytically if possible. For Black-Scholes European call option, it is possible. It is possible to derive analytical close from price that we know. We all know Black-Scholes equation, right? It's possible. Or you can solve it numerically. So there are methods called finite difference schemes, which we use to numerically solve this equation. Okay. From expectation also, you can derive analytical solution. After all, expectation is a integral, right? So if you can solve it analytically, you have a closed form analytical solution. For Black-Scholes, it is possible to do that. You start from here or you start from here. It is possible to derive the price of European options analytically. Or you can proceed with a numerical method. So numerical methods that use this equation are binomial tree, right? We calculate expectation by doing a backward induction from the right to the left. You can use Monte Carlo simulation. That's another numerical method. There are other type of methods also, semi-analytical kind of stuff, but let's not focus on that. So this is the valuation chain. Okay. Risk factor, stochastic process, stochastic calculus, pricing equation, then solution. This is the this entire chain or entire section is the focus of quant finance. So everything in red. All right, let me know if any questions. From a market risk perspective, this is not our focus. This is valuation. You have to know this till some extent so that you feel connected. Because if you don't know valuation, risk management would be a little hard because everything is connected, right? But you should not spend. I don't expect you to be like a Picasso in valuation for market risk purpose. If you are trying to build a career in financial engineering or quant finance, this is your lane. Okay, this is where you have to really shine. Okay, let me proceed. Let me complete the picture that will give you a lot of clarity in terms of what goes where, how everything is interconnected. Now let's understand this. This is the current scenario. Given the current value of risk factors and some kind of dynamics, stochastic process, right? We derive the value of the instrument. Again, the instruments, types of instruments are huge. There are a lot of different types of instruments, correct? Within each asset class, so many types of instruments. But pretty much following this route, you can attempt to price those securities. Now let's talk about future. What happens in future? When we say talk about future, there is a horizon associated with it. It could be, after what happens after one day, or you can say what happens after 10 days or after a year, right? What will happen in future is the risk factors will change. X changes by delta X, Y changes by delta Y, right? In future. But you don't know how much it will be because future is always uncertain. Nobody knows what uh, future holds for us. Once you figure out the changes, we can figure out the new value. Okay, new value of the instrument, which depends on these risk factors. These factors have changed, so my value would also get changed. So the question here is, and okay, this is done through a risk factor mapping exercise. That means which risk factors affect which instruments. A small note here, risk factor mapping is here also in the valuation exercise, but which is done by front office. But the risk kind of risk factors and risk factors mapping they do is different from what market risk folks do. Okay, in market risk we have the we typically simplify the set of risk factors. Okay, so instead of, let's say, I'll give you one example. Instead of modeling each and every stock individually, we just model the equity index, and everything else will have a will be related to the equity index through their beta coefficient, CAPM equation. Correct. Savio says, can it be said as bucketing? Yeah, bucketing is also part of this risk factor mapping. You're right. So it's a very simplified, mapping. Simplified in the sense we reduce the dimension of the risk factors in market risk. So this is the first thing in orange that you see, right? Risk factor mapping. How do we model the change in value from the change in risk factors? Okay, so for that we do a risk factor mapping. Now let's see. Question is, how do we model delta x and delta y, the changes? Okay, how do we draw delta x, delta y from a future scenario? That's part of scenario analysis and stress testing. Okay, scenario analysis. So depending on different scenarios, you figure out the changes delta x and delta y for each of those scenarios. Now, broadly, there are three approaches to do this. Historical method. So you go back in history and see how the risk factors have changed in history. That's all. Look at the last 1 year data and see how these risk factors have changed every day. Those are the scenarios that you're taking from history, right? Historical. Parametric method. Parametric method essentially means you impose some kind of distribution on the delta x and delta y. For example, you'll assume they come from a normal distribution. Once you fit a distribution, then that's a continuum of infinite scenarios, right? Anything is possible because I have probability associated with different outcomes. So parametric method, you have to impose some kind of distribution to the risk factors changes. And we have simulation. So Monte Carlo simulation, for example, again, for that you also need a stochastic process. So based on, let's say, geometric Brownian motion, I will simulate the stock prices in future, and there will be many possible values of change in stock price. Right? Once you do this, we can create basically at the end of the day, you're looking at some kind of distribution, whether parametric or taken from history, like what are the possible values of changes and their associated probabilities. Okay, so because there are two risk factors here, delta x and delta y, we have a bivariate distribution. Because x is changing, y is changing, how are they changing together? There will be some kind of joint distribution, right? And that can be constructed by following one of these methods. If you're talking about stress testing, it's kind of like a conditional scenario analysis. Your assumption is that something bad has already happened. Okay, in extreme scenarios, how the distribution would look like. So basically, your delta x, delta y changes would be huge, large, right? So we are focusing on periods of stress. So that's stress testing. Okay. So once you figure out the risk factor distribution by following one of these methods, the next step is to figure out the change in instrument value. Okay, risk factor change is just an intermediate step. This is my final target. In market risk, my entire focus is to model this. You figure out the change in value of an instrument, and you can also figure out the change in value of a portfolio, because change in portfolio value is nothing but sum of changes in value of the instruments. So your entire target in market risk is this: to model change in value of an instrument or value of a portfolio. How do I go from here to here? I have delta X, delta Y, multivariate distribution that tells me how likely these changes are. I need a single distribution for the portfolio change or the instrument value change. Something like this. To go from here to here, you need to know a lot of theorems and be very, very comfortable with probability statistics and bit of linear algebra. Anything that you see in green is part of the part of your foundation. It's your core, technical core. Okay. Stochastic calculus, as market risk professionals, you need to know a little bit. You cannot completely be blind to this. But if you are a financial engineer, this is like this is your ABCD, right? You start and end with this stochastic calculus. Probability statistics, linear algebra is a must for market risk. Okay, and this will help you to go from here to here. There are theorems and properties that we can use to go from here to here. So finally, I need a distribution for change in value of the instrument. That is my goal in market risk. Right? Now from here, what do you do? So this tells me, okay, these are the values, these are the change in values of the portfolio that are possible with their respective probabilities. So change in value equal to 0 has the highest probability, and there are extreme changes with low probabilities. Anyways, I need a probability distribution. That's my target. From here, I want to capture a worst case loss scenario. Worst case loss. Worst case loss scenario means at some given confidence interval, I want to estimate what is the worst thing that can happen. How much can I lose on 1 day or 10 days? Again, that depends on the horizon, right? There are popular risk measures that we use: value at risk, expected shortfall. I'm sure you must have heard these names. But from this distribution, we calculate risk measures, okay, VAR or expected shortfall, which is worst case scenario. Right? Happy with this till now? Any questions? I'll pause here. Anything that you see in orange is part of market risk. These are the topics you should be familiar with. Not familiar, you should be very good at it. Okay, all right, let's proceed then. Again, there are two approaches to find out delta V. One is called full revaluation, which means you shock the risk factors, revalue the instrument, again, full revaluation, and measure the difference, new minus old, delta V. That's called full revaluation. Or we can take a shortcut, directly find out delta V. That's called local valuation. And for that, you need to know this theorem. It's called Taylor series expansion. Taylor series expansion is the, what should I say, is the most important tool in market risk. Okay, so what we do in Taylor series expansion is we approximate the change in value of an instrument through sensitivities or Greeks. Okay, delta sensitivity, gamma sensitivity, vega sensitivity, and higher order sensitivities. Taylor series expansion gives us a formal way to link change in value of a portfolio to change in value, change in the risk factors. See, risk factor changes, delta X, delta Y, through Greeks or sensitivities. So to do this, you need to be a champion of calculus. Somebody asked me a question: to make a career in market risk, do we need to calculus? Here is your answer. This is exactly why you need calculus. Okay, basic calculus, not like crazy calculus. So you need to know, I would say you don't even need to know integration a lot. You just need to know derivatives. Okay, basic functions like log functions, exponential functions. You don't need trigonometry. Very basic polynomials, log functions, and exponential function. How to differentiate, chain rule, product rule. And the main thing is you need to know partial derivatives. So partial derivative means you differentiate with respect to one variable, keeping all others constant. Okay, so how do you calculate partial derivatives? So till that point, and Taylor series expansion, that is all you need for market risk. All right. Remember, green stuff that you see are part of your core. So that's foundation. Why I say it's as foundation is that you will need it all your life, whole life, not just for market risk. You are if you're signing up for quant um, profession as a whole, right? Stochastic calculus, probability statistics, linear algebra, all calculus, these are all your bread and butter. So I'm just pointing out where you need what so that you have a connected understanding. All right. Now, what do we do? Uh, Risk management. Once we have an idea of the kind of changes that can happen to your portfolio, we can perform risk management. So within risk management, what are the things? We have three main things. Regulatory treatment. This is a mandate, right? Because your banks I mean, you're systematically important, it's not systematic, systemically important institutions. So it is very, very important that you model the risk seriously. Okay. So for that, we have regulatory frameworks and you have to abide by it. So this topic is big in market risk, and this is what I have focused a lot on because there are a lot of jobs in this space. Okay. So we'll see what those are. So regulatory treatment, hedging is your day-to-day requirement. So you have limits in terms of the risk that you can take. So if you have taken more risk than needed, then you can reduce that risk by doing hedging. So you enter into different hedging instruments so that your overall risk is reduced. It can be duration based hedging, delta hedging, vega hedging, gamma, all these things can come into picture. So we can do sensitivity based hedging, right? So you can think of long and short positions having opposite sensitivities, neutralizing each other, that kind of thing. So that's hedging. And then we also have VAR tools and risk budgeting, where we learn about various tools such as marginal VAR, component VAR, things like that, and how do they help in optimal allocation of capital and risk. Risk acts as a budget because there is a certain amount of risk that you can take, not beyond that. Okay, so how do you invest in different portfolios that probably gives you higher return while still being under the risk? So there are a lot of tools as I talked about, right? Marginal VAR, component VAR, incremental VAR. So all of these tools we learn that help us in decision making and risk budgeting. Now let's talk a little bit about regulatory. Yep. Within regulatory, there are again two main topics. One is capital modeling. Capital modeling basically focuses on this worst case scenario. So using value at risk or expected shortfall, you arrive at a worst case scenario. That is how much capital you need to keep. Right? So that's capital modeling. And then model validation. This is also big. There are regulations around it. And what you're trying to do here is, in all of these exercises, anything that you have assumed or created has to be validated. You have to do a reality check and see, is it really what it is? What you have created or assumed, does it really hold true in reality? So all of those checks are part of model validation. Okay, within capital modeling, there are, earlier standard was Basel 2.5, then came 3. Before that, there was 1. Anyways, we don't talk about 1. In practice, today you'll find Basel 2.5 and 3 in place. The newest requirement is FRTB, which is only very, I would say, adopted very less at the moment. Not, banks have started adopting it. Not everybody has adopted it. It's difficult and it requires a complete overhaul of the old system. So not many banks have been successfully migrated to FRTB, and the standards are very stringent. So only few banks have done it. And there is also RBI norms. So we also focus on Indian context. So RBI is the supervisor. So there is RBI circular that I have also focused on. So from the course perspective, I have spent a lot of time explaining the rules and deriving them and calculating end-to-end capital charge. So we start with a trading book portfolio of different types of instruments, let's say equities, interest rate, both linear instruments, non-linear instruments. So take that trading book portfolio based on these one of these standards, calculate the capital charge. Okay. Again, each of these standards is divided into a standardized approach and an advanced approach. So you can imagine how complicated all of these are. Three things, right? First thing, you need to know all of these background maths, right? To calculate sensitivities and things like that. You need to know the regulatory framework rules and how to apply those. You need to know all those equations that appear on this paper, right? They should come to you naturally. You should not be memorizing them. Okay? How do we do risk aggregation at the portfolio level? So there are equations, but those equations should come to you naturally. If you build a strong foundation in this area, right, all of these would be easier for you. Okay, so having said that, yeah, so I have created lots of Excel sheets that we use. We prefer Excel for these calculations because Excel is transparent. So all the calculations will be right in front of you. Everything is transparent. There is no Python package magic button that I can click that will give me the results. Everything is handcrafted, transparent. So three types of things we give in our teaching. One is handwritten notes. If there are like derivations that need to be done, so we don't assume any black box. I derive everything by hand. So you'll get handwritten notes for derivation. There will be neatly written PDFs which summarize a particular framework, right? What are the key components, key calculations, background theory. So PDF. I'll show you some samples right after this. And the third thing, which is our, I think, USP, is the Excel files. So we have lots and lots of Excels. For every single exercise, we created in Excel. So you guys have an end-to-end understanding of all the calculations. No black box. There is a fourth artifact that also we create, which is animations. Sometimes, we get lost in these jargons and equations. It really helps to have some kind of a visual understanding of the processes. So as much as possible, I also try to include animations in Excel. So this is the coverage from a regulatory standpoint that I have done from market risk. And for model validation, there are numerous checks in terms of all the assumptions that you have assumed so far for all the calculations. But to highlight, there are two specific model validation requirements specifically for the advanced approach, which is profit and loss attribution testing. This basically tells you that when you generated this particular PNL distribution, is this accurate? Is this PNL distribution that you generated, right, based on your risk factor mapping and all this, is it aligning to the real PNL distribution, actual profit and loss distribution? So that alignment check is this. And backtesting focuses on this one. So when you said the worst case loss is, let's say, 100 million, and there is only 1% chance of exceeding that, that 1% chance, which is, it'll be part of VAR measure. If the confidence interval is 99%, then you are saying there is a 1% chance of exceeding that loss. You check that statement as part of backtesting. Okay, is it really true that for your, based on your VAR model, if it's a 99% VAR model, then how many times the actual loss exceeds the VAR loss? Is it much more than 1%? That is what you test in as part of back testing. So yeah, I think I've summarized everything pretty much. Everything that you see in orange is part of market risk. All of those are covered in the course and through derivations, through Excel files, through notes. Okay, let me show you a few samples on these topics and you can let me know if you have any questions. Okay, so let's see. Um, yeah, so this one is FRTB standardized approach for equity portfolio Excel sheet. So few equity instruments are here. This particular flow chart tells you how do we go about bucketing the risk factors and getting the risk weights and capturing the sensitivities, aggregating them based on the rules. So I have numbered the steps 1, 2, 3, 4, 5, 6, 7, 8, and yeah, delta risk charge is this much. Okay. Similarly, uh, curvature risk charge. For that, you need to understand the concept of long gamma and short gamma. And here is the calculation for curvature charge. Then we have DRC, default risk charge calculations. Okay, so for every regulatory capital calculation, we have taken some simple, case studies with sample portfolio of few different types of instruments, and then doing the end-to-end exercise in Excel. I think this is the best way to learn all the inner workings of a particular capital standard. So this is one. Let me open another one. Um, yeah, maybe I can show you the. So periodically, I take workshops. So on a particular weekend, we will announce a workshop, and we will in that Saturday Sunday session for 4 hours each. Within 8 hours, we'll try to cover an end-to-end modeling exercise. So, for example, a few days ago, I took this uh, internal model approach value at risk calculation. You'll get notes like this. So this is the kind of note that you'll get. So this is the risk factor mapping, sensitivity calculation, um, aggregation. This is the note that I was talking about. And in terms of modeling, I'll show you how we do it. So risk factor returns, calculating all the sensitivities, then P&L modeling, 1 day, 10 days, uh, finally value at risk and stressed value at risk. Okay, so this is one example of end-to-end implementation. Let's see. I'll show one more example of this plat and back testing. Again, done in Excel. Let's see. Yeah, here it is. So normal backtesting approaches, right? Normal test, we have traffic light approach. This is the one that is used by regulator. And discussion on type 1, type 2 error, very, very important. Theoretical background behind this. And yeah, different types of profit and loss attribution test. So we have Spearman correlation test, KA statistic. And this is the example, end-to-end example of we have different types of P&Ls, actual P&L, hypothetical, risk theoretical P&L, right? This is the one that we use for VAR calculation. And finally, the back testing. So how many accident breaches that you saw? There are 5 breaches and PLA test. Okay, so so as I was saying, we cover everything from scratch with all the notes and derivations. I'll show you one last thing. Probably, let's see. So if something is high touch, topic, then I derive everything by hand, right? Otherwise, the formulas. I mean, what would you do? Would you memorize all the formulas? Of course not, right? So this is one example of handwritten note of valuation of FRAs, swaps, bonds, right? So yeah, I derive everything by hand. Swap rate, things like that. All right. So that's all about market risk. Any questions? I mean, of course, there are a lot of other topics inside of each of this one. This is at a very high level, but this is just to give you a big picture or macro picture of what market risk is all about. What are the key areas that you need to build your skill and expertise in? So, a lot of jobs on this and this today. All right. Question from Savio: to what level do you cover the core mathematical concepts in the course? I would say until you get enough empowerment and freedom to do everything yourself. So all the equations in FRTB capital charge calculation, you would be able to derive it naturally by yourself. Right? So I give it my 100% to make sure there are no black boxes and I derive everything by hand. Yes, FRTB, SA, IMA is covered. Basel 2.5, RBI norms, everything is covered. Derivative valuation, as I said, is, truth to be told, that is the core focus of quant finance. But for market risk, you also need to have some understanding of valuation. So I have covered the valuation of all the I would say plain vanilla instruments and first generation exotics like swaption, till swaption, right? Nothing too exotic, but till swaption. All the pricing models and valuation exercises have been covered. Yash has a very good point. What is the intersection between market risk and treasury ALM rules? One answer is IRRBB, interest rate risk in banking book. So that is the market risk of banking book, which is part of Pillar 2 capital charge. Okay. Again, regulatory capital is divided into Pillar 1 versus Pillar 2. So all of these standards, right? There is a Pillar 1 and Pillar 2. Pillar 1 is the minimum capital requirement that you have to meet to do your day-to-day operations. And then on top of that, there is Pillar 2, okay, which is part of your ICAP and stress testing. To back to your question, for within Treasury and ALM, we have interest rate risk in banking book. For that, you need to know market risk. Otherwise, you will not be able to calculate the interest rate impact on banking book products. Okay. Question from Lakshay: which is better for fresher, BSc in maths, non-coding background? Coding these days is has become a commodity. You just need to know Python basics. Anybody can learn that. After that, you use AI to get the code. Trust me, today you don't have to see AI is generating very good code with comments and everything, production level code. You don't have to write down each and everything. My recommendation is learn basic Python such that you can at least understand and interpret the steps that the AI generates for you. Okay, but you don't have to write code unless you are into hardcore quant finance role where you're in the production front office role where you have to write cutting edge either advanced neural network based implementation for pricing and all, or writing efficient code in production for faster execution. So unless you're going to that level, I don't think you have to write a lot of code. You use AI and then refine it. That's all. Yeah, that's what I am doing right now. So any other question, guys? Oh, Lakshay had a question from non-Codiver. What is the best credit risk or market risk? See, it depends on your aspiration. If derivatives excite you, if calculus excites you, go for market risk. That's all I can say. In credit risk, yes, there is modeling. There is PD, LGD, EAD, all kinds of modeling. It would not be, there is no stochastic calculus in credit risk. Okay, so this is the, I would say, main difference. You have to be a Picasso in calculus for market risk, right? In credit risk, not much calculus, no calculus. Just you have to be very strong with time series modeling. In market risk, also you need time series modeling, but at the same time you need lot of linear regression and logistic regression, different types of machine learning algorithms. They fit naturally to credit risk because you are classifying probability of default, right? All classification algorithms in machine learning can be used in credit risk. Savio has a good point. So for model validation, we had this gold standard called SR 11.7. Very, very recently, we have a new regulation that has come up, SR 26.2. Definitely, it's on my radar, and I will try to do a comparison and take a session on that uh, in future sometime. Where is the fresh batch starting? So before I answer that, if you join the course today, right, you'll have access to the pre-recorded lectures for everything that you see on the screen. Plus there will be there will be integrated workshop sessions, as I mentioned, right? So one particular session will focus on, let's say, Basel III capital charge. Another session will focus on, say, model validation, right? So I take that in rotation mode. So every now and then I'll announce that on this weekend we'll cover this entire end-to-end. So that's the live element to our workshop. But the day you get enrolled in this course, you get access to everything. Everything is pre-recorded. You will get access to videos, notes, PDF notes, Excel files, handwritten notes, everything. There are a few more questions. So to be a, let me see. Will there be any pre-material to learn about calculus? So everything I have covered from scratch. You'll have a lot of primer sessions on calculus. You don't have to go anywhere. So you'll get everything in the course. Uh, so Apurva has a question. IRRBB, NII, EV, and fund transfer pricing, everything is covered as part of another offering, which is called treasury risk. Actually, it's called ICAP, ILAP, and ALM. So it's a separate course. This is not covered under market risk. All right, let me do one thing. We don't need to spend a lot of time. Let me briefly introduce counterparty credit risk in the next 10 minutes, not more than that. And I'll show you some sample Excel and files, how we have taught this. And then if you have any questions, we can discuss. Okay. So counterparty credit risk, as you can see in the name, we have credit risk. So it has to do with default, right? The tricky part is that counterparty credit risk is applicable for derivatives, right? So let's say you are long and the other guy is short for any kind of derivative. It could be, options, it could be futures, FRAs, anything, any kind of derivative. The risk is if counterparty owes you money because your position is in the money, that means counterparty owes you money, and then he defaults, doesn't give you what he owes. That's counterparty credit risk. Okay, the loss is given by this formula, right? PD times LGD times EAD. This is the standard credit risk formula for modeling default based loss, correct? Probability of default, exposure at default, how much you can lose, and loss given default. PD, LGD are part of credit risk scores. So you discuss at length of each and every aspect of PD and LGD. So that is part of credit risk scores. in this course, we focus on this guy, exposure at default. How much can you lose? That is tricky because it is stochastic. So today the value of the derivative is V0, right? In future, after let's say 20 days or something, what can be the value of the derivative? Because when the counterparty defaults in future, he's not defaulting right now. He'll default at some point in future, and the money that is owed to you will not come to you because counterparty has defaulted. So the question is, how much can you lose? The answer is we don't know, because in future the value of the derivative can be anything, right? So right now the value is V0, but at time t the value can be anything. So what you need to do is do a full-blown Monte Carlo simulation, but it is not simple. See, we all know how to simulate, let's say, stock price. Geometric Brown motion, you draw random normals and then you simulate stock price. That's okay. Interest rate, can you simulate? Yes. Give me a stochastic process. Vasicek model, CIR model, Holy model, Ulurn White model. I can simulate interest rate, no issues. That's not the end of the story. We are looking at different possible values of an instrument, not the risk factor. Okay, model simulating a risk factor is cakewalk. But based on different realizations of, let's say, stock price, what are the possible values of the call option which depend on that stock price? So we are looking at future possible values of a derivative. That's not easy. Okay, it requires sophisticated pricing algorithm within this Monte Carlo simulation that can help us derive the distribution of prices of a given derivative in future. Okay, so that's where all the complications or maths is. And once you get the distribution, there are few metrics that we calculate, exposure metrics from the distribution. This is called exposure distribution. Expected exposure, effective expected exposure, expected positive exposure, things like that. So to do this, you need to know pricing engines for derivative valuations. You also need to know Monte Carlo simulations, and you need some fundamentals around netting and collateral basics. Okay. Once you know all this and you're able to derive these, then you can calculate these things, which are part of the regulatory treatment. So within regulatory framework, there are two types of capital you need to calculate. One is CCR capital, counterparty credit risk capital, which captures the loss due to counterparty default. There are two approaches: standardized approach, SSCCR, then internal models method, which is the advanced approach. And then the other side, we have CVA, which is credit value adjustment. It's a value adjustment. Because counterparty can default, the fair value of derivative is adjusted by CVA to reflect the fair value. Okay, there is a risk neutral pricing, which is, let's say, Black-Scholes. That's not the end of the story, because Black-Scholes does not capture the counterparty's default risk. Your valuation has to be updated to include the impact of counterparty default. That is done through CVA, and that CVA itself can fluctuate because CVA is based on counterparty's credit spread right now. Tomorrow, the credit spread might go up, go down, and that has direct impact on CVA. So to capture the CVA-based capital, there are two approaches: basic approach and standardized approach. Everything has been covered in great detail. Let me show you a couple of samples. So for example, this is the exposure profile. So how to create an exposure profile for FRA for a swap, right? Forward swap. So a lot of simulations behind the scenes, and there is a valuation engine. Similarly, this is the SSCCR note that you'll get. So all the theory and everything is explained in detail. So I kind of take the regulatory text and dissect it because it's sometimes hard to follow the paragraphs. So, tables and notes help you to understand the context much better. In fact, I have derived all the formulas for SSCCR. how do we arrive at this formula? Or for example, supervisory factor, how does that come into play? So I have derived everything for these formulas. Okay. So this is SSCCR notes, and similarly we have CVA, right? So let me just show you. This is SSCVA capital charge. Similarly, we have BACVA. So take a set of counterparties, then take set of instruments and calculate your delta risk charge, vega risk charge, FX delta, FX vega, right? So this is as part of SSCVA capital charge. So as I said, whenever required, you'll get the handwritten notes for the derivations. You'll get neatly written notes to that explain the regulatory text much better in a more readable format, and Excel, completely transparent Excel sheets, taking simple set of instruments and then doing the end-to-end capital charge calculation. Okay. Let's see what else. Yeah, those are the things that I wanted to cover in this webinar. So I hope you got a good understanding of what market risk is all about. What is counterparty credit risk? What are the big areas that as a professional you should focus on? There are a lot of jobs in all of these space. Okay, you'll see. Just look at LinkedIn and see what are the keywords that they are looking for in terms of the job description. So you can take a look. I think that's pretty much what I had. Any questions we can discuss? Let me stop recording here.